Well, we got some oldies but goodies on the program for y'all today. Welcome into the program. Hopefully your week is going well. We've got some topics on the show that certainly have been talked a lot about over the course of the years that the program has been on, but sort of warrant more discussion along the way. Sort of like, I guess, the movie season this summer, right? We saw another version of Mission Impossible. We saw another version of Indiana Jones. I think it's like Mission Impossible 29, Indiana Jones number 18 or something like that. I lose track of how many there have been. The reality, of course, is that as we saw this summer in the movie theater, the new stuff or the new take on old items, Barbie, right? I mean, that's a pretty old product that now all of a sudden, after all these years, had a movie that wound up being very successful. Same thing with Oppenheimer, right? That was a historical movie about the invention of the bomb. And so using those old topics, but I guess sort of refreshing them, was ultimately what won at the movie theater this past summer. So we're going to delve into a couple of topics on the program that have to deal with items that have been around a long time that have had some things change that you need to be aware of because it does impact the decision that you might make with them. First and foremost is the oldie but goodie conversation about, should I do the traditional IRA or should I do the Roth IRA? To recap the difference, right? If you're doing the traditional, you're saving taxes now, but that means when you use the money, you got to pay taxes in retirement. Roth, it's sort of the flip side of that, whereby you don't get the tax savings now. You have to fund that with after-tax money, but then when you take it out in retirement, lo and behold, it is tax-free. Well, one of the biggest things that has happened is sort of the expansion of the Roth option, particularly in the 401k landscape. Plus, there's also been some other things that have happened over the course of the past several years that warrant sort of a rehash, if you will, of that oldie but goodie conversation. And then on the program, we're going to update you with the latest Florida retirement system changes. So there's about 2.6 million people that are impacted in the form of active employees, former employees, retired employees in terms of these changes. So if you work for the state of Florida or you know somebody who does, then this show is for you because we've got the latest updates on the Florida retirement system to share with you on the program this week. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you also on a host of podcast platforms as well, where our online audience downloads our show to the tune of about 1,000 episodes each and every month. So we certainly appreciate our listening audience on those various social media and podcasts and even YouTube platforms. If you'd like to get connected to us on those platforms, make sure you go to our website at Nelson Financial Planning, and you'll see a bunch of icons. If you click on any of those icons, we'll get you directly connected to our channel on those particular platforms. Once you're there, make sure you subscribe, and then that way you don't have to ever kind of search for us again, because then it will be part of your subscriptions that are part of your podcast or YouTube platform. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well, who stand ready this week to help you change your life with a successful and cost-effective financial plan. So certainly over the years on this program, we have talked a lot about the Florida retirement system. As you might well imagine, with a pension that size, almost $200 billion in that pension system, that it generates a lot of conversation. There's a tremendous amount of Floridians who are impacted by what's going on with the retirement benefits with the state of Florida. Why? Because, well, first of all, the state of Florida as an institution is one of the largest, if not the largest employer in the state of Florida. And there's about 2.6 million people that at one point either work for the state or retired from the state or are currently working for the state. So if you are in that category where you had at some point in your working career an affiliation with the state of Florida, or maybe someone in your family or in your circle of friends had that connection, then there are changes that happen each and every year that sort of get implemented right about summertime after the legislative session ends here in Florida. As you know, Florida legislature typically meets March and April, and then they pass a bunch of bills, or in theory they pass a bunch of bills, and the effective date of a lot of those is typically July 1. Well, lo and behold, were some significant changes as it relates to the investment plan and as it relates to drop. Now, just to recap, as a state employee, you have an option among 3 different choices when you retire, right? So there's the traditional pension, there is, which is sort of that check a month club. There's the investment plan, which looks a lot like a 401k, where you take your lump sum that is the amount that represents the amount of your pension check, and it converts over to a lump sum. Or the third option is drop, which is a deferred retirement option, where you retire under the pension plan, and then the drop money, the drop account, is sort of a holding bin, if you will, for that pension check, because if you still work for the state, you don't get to also collect your pension check. So those 3 options, each one of them very, very different. And ultimately, the changes had to deal with the investment plan and had to deal with drop. And interestingly, in the past, when we've had this conversation, we've had to sadly give state employees the bad news that some of the benefits were getting cut, or this was less, or they had to do this, and they didn't before they had to, contribute to their own retirement. These changes are actually positive. So we've got some good news on that in terms of potentially getting more money, potentially having a little bit more flexibility, things like that. So one of the things that we did many years ago to sort of boil down all of these state of Florida retirement options is we create a little booklet. It's available on our website at Nelson Financial Planning. We encourage you to go to the website and download the booklet. Now, we're going to update it probably in the next month or 2, and that will be the 5th edition of that booklet to sort of incorporate some of these changes. But in terms of the general overall perspective, that booklet available on our website has a lot of the details about each of those 3 options within the state of Florida. And then we're going to talk about the Roth versus traditional. That's a discussion item that's been going on for 20 years. I remember way back in the day running software and spreadsheets and all that kind of thing, running the comparison. But there's been some changes of late, and a lot of that has to do with where tax rates are, where we think tax rates might be, and of course, the fact that more and more employer plans offer Roth. So we're going to revisit that oldie but goodie conversation in detail here on the program. So welcome on into Dollars and Cents. We'll continue after these messages. This is Joel Garris of Nelson Financial Planning. Are you a state of Florida employee, or maybe someone in your family is, or perhaps in your circle of friends? Well, on this segment of the program, we're going to talk about some of the changes that have happened inside the state of Florida system. The state of Florida retirement system has really been subject to a tremendous amount of changes over the course of the years. And particularly, you saw that sea change start to happen after 2008. 2008, obviously the year of the great financial crisis, as many like to describe it. And during that time, the markets dropped quite dramatically. There was a 60-day period in the fall where the markets actually declined about 40% within 60 days. So not particularly great. Also not particularly great if you are running a pension plan. Why? Because a pension plan, whether it's the state of Florida's or the state of California's or the state of Illinois' or a private company pension plan, is invested, and it's invested typically in what we would consider to be a balanced investment allocation. So it might have, say, 2/3 in stocks and 1/3 or so in bonds, give or take. Those are kind of the rough split that you would expect to see on a pension. And so in 2008, market declined pretty dramatically. Folks at the state of Florida are looking at the balance in the pension plan saying, wait a minute, there's a lot less in here. And so now our funding obligation is going to increase unless we do something, unless we change the terms of the deal. And certainly, if we think back to some of those changes that have happened over the course of the past 15 years or so, one of the biggest of which is elimination of any cost of living adjustment for your retirement. Another one requires you to contribute 3% into your retirement plan, where before you didn't have to do that. So a lot of the changes that we've seen since 2008 have been negative in that they have cost you money. And the good news is that a lot of the changes that we're going to talk about in this segment that are courtesy of the most recent legislative session are actually positive news. So we've got some good news to sort of share with you as it relates to state of Florida, particularly the different retirement options that we have. As we mentioned in the prior segment, for a lot of detail on those three different options that you have under the state of Florida, there's the pension plan, there's the investment plan, and there is drop. Years ago, we created a booklet. Every 2 or 3 years, we update that. We're going to update that again here in the next couple of months. That booklet is available on our website at nelsonfinancialplanning.com. It's called The State of Your Retirement, the Essential Guide for All State of Florida Employees. So if you know someone that works for the state, or maybe you work for the state, or maybe someone in your family does, it's a great booklet to go and download and to utilize just as a resource guide in terms of what's the difference between the pension plan, which is your traditional check-a-month club, what's the difference with the investment plan, which looks more like sort of a lump sum 401k type thing, and then what's the difference with the drop, which is the deferred retirement option, which is where you elect to retire under the pension, but you choose to remain an employee of the state of Florida, so you're continuing to work, but you're not allowed to collect your pension if you're continuing to work. So basically, drop is sort of like a holding bin, if you will, for that retirement check. Now, here's the reality of these FRS options and why it is so important that you understand kind of what the differences are and why. Because the reality is that the decision that you make is often or is irrevocable. Typically, when you first get hired with the state, you're given sort of a window where you can make a decision. These days, there's default options over into the investment plan, but you can still make that decision to choose a different option within the first few months of when you work for the state. There's also a second election that gives you sort of one more bite at the apple to make a change or make a difference between the option that you might have originally selected. But then that's it. And once you're locked in, you are locked in. So it becomes irrevocable. So this decision is not one to be taken lightly. Sadly, though, I think a lot of people sort of don't realize that. And so when you go to work and you look at these options, and you may just sort of gloss over them, if you will. So it's so important to sort of understand the differences between these changes, and also be aware of the updates that happen along the way. So the two biggies, if you will, that came out of the legislative session, and there's a third one which I think we'll get to as well, but the two biggies that are specifically geared to the state of Florida retirement benefits have to deal with drop and have to deal with the investment plan. So here we go in terms of the drop. So the drop is that deferred retirement option, right? So it means that you retire out into the pension, and then that drop account is basically sort of a holding bin for that check. I remember sort of countless times where we've sort of been having this conversation with folks in the office, and I don't think people quite realize, and we've certainly seen it firsthand on a number of occasions, that when you go into drop, it's not like it's extra money. That deferred retirement option lump sum is not extra money. It's not a bonus. It's not a kicker. It's not any of that. It simply is collecting your pension check and sitting it in an account while you continue to work for the state. And what surprises people then is that a lot of people think that when the years that they spend on drop helps to increase the amount of their pension, because one of the parts of any pension calculation is your years of service. So the same thing applies for the state of Florida. But the problem is it doesn't. When you go on drop, it freezes your pension. You have effectively retired for all intensive purposes. So what that means is that you could spend time on drop, but it ain't going to increase your pension amount. So one of the things that's kind of odd in terms of these changes is that they've extended the amount of time that you can spend sort of in drop purgatory. It used to be that it was only 5 years. Now you could spend up to 8 years in drop. So basically you retire out, you set your pension, and then you could spend up to 8 more years working for the state. Meanwhile, all the drop account is doing is it's just collecting the pension check that you would have normally gotten had you not kept working. What's even more interesting about some of these more recent changes is if you're a teacher, you get the opportunity to spend even more years in drop purgatory. They extended the drop period of time for an additional 24 months beyond the 96-month or 8 years that you can now do drop. So literally, as a teacher, you could spend 10 years on drop. I don't know too many teachers that once they get to retirement, they're like, hey, I'm going to go another 10. That really doesn't happen. So, but the good news here on drop is that the interest rate increased from 1.3% to 4%. So to the extent that you are on drop, then you're getting a better rate of interest. Certainly nowhere near the 6.2 or 6.3% it was a few years ago, but 4 is certainly better than 1. So certainly an interesting or a positive development, particularly if you're on drop, that your money at least is making a little bit more money while it is sitting there. And then the other big positive that happened is on the investment plan side of things. So the investment plan side of things is funded predominantly by your employer. They contribute a certain amount of your salary each and every year into that investment plan. And so these contribution rates have been all over the map. Prior to 2008, as you might well expect, those contribution rates were quite high. 2008 happens, and all of a sudden the contribution rates get cut and go down. They have stayed down and haven't really changed much until this most recent legislative session. So again, some good news here in that the employer contribution rates were increased by a total of 2 percentage points going forward. So what that means is that if you are a regular class employee, then instead of 9.3%, you're getting 11.3. If you're special risk, then instead of 17% getting deposit, 17% you pay getting deposited into that investment plan, then that is up to 19%. So good news, Bad news, unfortunately, is that it still is much less than what it used to be. So for much more information on all of this and all of your options under the state of Florida, go to our website, nelsonfinancialplanning.com. We've got a guide there, a little booklet, State of Florida, the state of your retirement, the essential guide for Florida employees. And make sure you download that to get a little bit more information about what we've been talking about in this segment here on Dollars and Cents. So it's sort of a tale as old as time, if you will. And no, we're not necessarily talking about the summer movie season that saw Mission Impossible 29 and Indiana Jones 28 or something like that. It really is amazing how many different franchise movies have come out as the next version of it. And interestingly, the box office did not exactly applaud those much this past summer. Personally, I saw Mission Impossible, not to give it away, but apparently the impossible mission winds up being possible under the guidance of Tom Cruise. So good on him. What you need to know about that movie, though, is that it's part 1 of 2. So you're kind of commit yourself to going to next summer's supposed blockbuster because the second part of or the second movie doesn't come out till next summer. Anyway, we're not talking about movies on the program because after all, this is Dollars and Cents, where we're trying to make sense out of all of life's decisions involving your dollars. We're going to talk about an oldie but a goodie, the old Roth versus traditional debate. And in a way, it's sort of been rekindled a little bit more so because of the prevalence or the expansion of the Roth option among your employer-sponsored retirement plans. So think about 401ks and things like that previously would not really have had a Roth sleeve, if you will, but they are going to have that sleeve. And in fact, many of them are starting to adopt that. In a couple of years, they're going to be forced to have that as an option. This whole conversation sort of overlays what Christina and myself were talking about on the program last week. If you missed the program, you can go to our podcast channels, you go to our YouTube channels. If you have any trouble finding us, go to our website, Nelson Financial Planning. You'll see all the different podcast platforms and you can get connected directly there. The reality is that as Christina Lamb, who's a fellow certified financial fiduciary, also happens to be an IRS enrolled agent here at Nelson Financial Planning, and I were talking about is this notion that starting in it was going to be next year, that the catch-up contribution, so if you're over age 50, you can do a catch-up contribution, which means you can put more money into an employer-sponsored plan. This year, it's an extra like $7,500 that you could put in. And starting next year, the IRS said, well, wait a minute, we want to actually generate some tax revenue on that now. So we're going to force you into, if you're doing the catch up and that means you're over 50, then you've got to do that on a Roth basis. You can no longer do that on a traditional basis and get the tax deduction. You've got to do that on the Roth side. So, and that applied if you were higher income earning as well. So if you had made over $145,000 in the prior year, you were in essence going to be forced to do the Roth as it relates to your catch-up contribution. So what we were talking about on the program last week, I think we may have even talked about earlier in the summer when Kristen Cayley, another certified financial fiduciary, who's also a CPA with us at Nelson Financial Planning, joined us, is that a lot of companies had said, well, wait a minute, we can't get this all done by 2024. It's just too quick to add a different sleeve into our employer-sponsored plan. We're just going to need more time. Well, lo and behold, the IRS actually heard them and not this past week, but the week prior, announced that they were going to extend that to 2026. But here's the reality. It is coming to a theater near you, and your employer-sponsored plan will have a Roth sleeve. It may not necessarily now, although more and more are, but it will have that going forward in order to address this particular change, if you will, that the IRS has promoted. So just to recap, let's at least set the stage before you get any further on the difference between doing a traditional versus a Roth. So it's basically a conversation about, do you pay now or do you pay later? And I'll tell you, this has been sort of one of the biggest raging debates that you hear people talk about across the board when it comes to your finances. So we get that this is perhaps one of the more confusing selections that you have to make, because it really is kind of one of those things where, well, if I pay now or pay later, what's the current look like versus the future? I mean, at the end of the day, there's no real right or wrong answer on this, because each one has pros and cons depending upon how the future spins out. Because the IRA is I'm going to save money on the taxes now because I get the tax deduction now. But then when I take the money out, I've got to pay taxes on it. IRAs also have a required minimum distribution, which means that you have to start taking the money out over at a certain age, and that age is 73. The reality is, and it's funny when we think about the RMD, how many people get sort of hung up on that? Because for most people, if you're retired, you're taking money out of your accounts. And if you're taking out a reasonable amount of money from the accounts and not taking out too much, but even that smaller, more reasonable amount is going to satisfy your required minimum distribution. So it's not like the required minimum distribution is on top of what you must take out of those accounts. It's the minimum. So once you've sort of satisfied the threshold, then you're all set on it. But IRA monies do have that required minimum distribution rule that you must observe. In contrast, Roths, on the other hand, you don't save now, but you save later, because when you put money into a Roth, there's no tax deduction now, but when you withdraw it, it is tax-free. Similarly, there's no required distribution on it. So that's sort of the, kind of the background, if you will, of this choice and this debate that's sort of been raging on for years and years. But here's where, I guess, with the passage of time and these oldie but goodie conversations there's always reasons to sort of rehash it. And I think there's 4 different things that are happening now that do kind of shift the thought process a little bit. And the first of all is just the ability to have that as an option. There's a lot of times where you didn't have the Roth option, and so it was kind of a moot point, right? But consider that we're in an environment of lower income taxes. That's number 2. Consider number 3, the specter of higher tax rates in the future. I think that's probably going to happen. And then lastly, number 4, the elimination of the ability for your beneficiaries when they inherit these accounts to stretch out the distribution of the money over an extended period of time. The elimination of that stretch IRA is really pretty significant. I mean, it requires a much more finely tuned analysis on cash flow and tax planning. I know at the office, we've been regularly sort of creating almost like these Excel spreadsheets, or they are Excel spreadsheets, that looks at, okay, well, if this income is coming out in this year and this income comes out in this year, and in one particular case, it for this particular person, it made sense to, well, you might as well not take your Social Security, because if you don't take it and it continues to increase every year that you don't take it up till, say, age 70, because you have to kind of take this money out over the retirement account, and that's going to provide you with sufficient amount of income because you have to take that. You might as well wait on Social Security. So those are kind of a little bit of the nuances, if you will, of how this can play out very differently, particularly with this notion of the stretch IRA. Because the reality is that between the traditional versus the Roth and what you should be doing, I mean, this is a terrible answer, but it kind of depends, right? I mean, if you're younger and in a lower income bracket, then the Roth makes sense. Like if we're sitting with somebody during tax season, we're looking at a tax return, at their tax return, And lo and behold, they're in like the 12% bracket. Well, then, okay, yeah, I get that. Then that would make sense to say, okay, I'm going to pay the taxes now because taxes are pretty low, and I'm going to do the Roth. Meanwhile, if you are older and higher income, then perhaps you do the traditional to save money on your taxes there. Bottom line, think about it as a real choice. It's not just something you just blindly select. It really requires you to take a look at your tax return. And this is something that whoever you're using as an advisor really needs to do as well in order to make the best possible decision of whether the traditional or the Roth approach is right for you. We're going to take a break and return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program. We hope your week is going well. On the program, we've been talking about some of the oldies but goodies conversations that we've had over the years, giving you an update on the latest changes for the Florida retirement system, along with sort of a rehash, if you will, of the traditional versus the Roth and what one makes sense for you. Got one other item that we wanted to add to the Florida retirement system change. Another big change, which didn't necessarily have anything to do per se with the retirement benefit options that you get between the pension plan, the investment plan, or drop. This one actually had to do with the health insurance subsidy. So regardless of which of those three options that you retire out under, you get a health insurance subsidy that is a certain amount of dollars times the years that you've worked for the state, and then you get that to help offset the cost of your health insurance. Well, and that benefit is often overlooked. A lot of people think that, if I go on the investment plan, I don't get the health insurance subsidy, or if maybe I do drop, it's not as valid. The reality is that it is always an option regardless of which you pick as your retirement option under the state of Florida. So the good news on that is, and as an additional positive development from the Florida legislature this year, your health insurance subsidy increased, or at least the state piece increased from $5 per year of service to $7.50. So in terms of numbers, that increased that monthly subsidy amount by a maximum of what was $150 to $225. So basically kind of a 50% increase on that part of the benefit. We wanted to make sure that we mentioned that as well, because that's a nice little positive development after a lot of years where the Florida retirement system has sort of been tinkered with to kind of offset some of the pressure that most pensions feel these days in terms of being able or requiring having to pay out a certain amount of money, and obviously folks living longer and those pension checks get longer and longer. So, but a nice little additional kicker for the health insurance subsidy as well. Also want to share with you one of the comments that we got this past week. And again, great opportunity for us to just mention that. If you're a listener to this program, whether it's here live on the radio during the course. Well, we lost power during the break, so we're coming to you the old-fashioned way through the cell phone, which we haven't done that for a few years, but still coming to you from the Nelson Financial Planning Studio, except that none of the lights are on, although the lights are on because the laptop that we're using at least is charged. So that's running some of the lights. Anyway, we thank you for bearing with us on the program. We're talking about oldies but goodies, so only appropriately that we're doing the last segment on the phone in order to finish the show. The reality is, much like we saw this past summer, a lot of oldie but goodie movies. This show, we've been talking about some topics that we've certainly talked about at length before, specifically the state of Florida and the latest round of changes that have occurred for the retirement benefits under the state of Florida. Similarly, we are also talking about that age-old sort of debate, if you will, between which one is better. Should I do the traditional or should I do the Roth? Again, if you're interested in learning more about some of those state of Florida options, we've got a booklet on our website at Nelson Financial Planning that you can download and ultimately look at sort of a much greater description of those pension plan versus investment plan versus drop options. We'll update it here in the next couple of months with some of the big changes that have happened this past year. Speaking of changes, one of the changes that did happen as well in the Florida legislative session is that the health insurance subsidy was improved. Now, this one is separate from the pension plan or the investment plan or drop, and you get it regardless of which of those three options that you have selected. But it is a subsidy intended to help offset the cost of your health insurance. Well, as you might well imagine, health insurance has been going up a bit over the course of the past many years, but the state's contribution for that health insurance subsidy really hasn't changed much. It's always been sort of $5 per year service. Well, lo and behold, they increased that number from 5 to $7.50. So a 50% increase in the state's contribution to that health insurance subsidy. So that means that the maximum amount you can get from the state went from $150 to $225 for that health insurance subsidy. So another sort of positive development on top of some of the positive developments that we discussed earlier, involving an increase in the employer contribution rates by 2% to the investment plan side of things. And then on the drop side of things, having that account increase the cumulative rate from 1.3 to 4%. So after so many years of folks that work for the state getting sort of the short end of the stick, the reality is that this past legislative session saw things actually improve for state of Florida employees. So some positive developments there. Speaking of positive developments, one of the things that we talk about on the show is we always appreciate it when people call us during the course of the week and say, hey, I heard you say this, what about this? Or I heard you say this, here's what I have run into on a personal basis that I think it would be important to share with the listening audience. And we had one of those conversations this past week. And again, we encourage our listening audience to do that. Maybe it's an additional comment that you want to make about something that we said, or maybe it's a topic that we haven't talked about in a while. And so you want to kind of hear the latest and greatest on that. So if that's the case, just reach out to us either through our website at Nelson Financial Planning. You can hit the contact us button and reach out to us through there, or you can call us at the office, 407-629-6477. In this case, one of our longtime listeners reached out to us to talk a little bit about what Christina and I were talking about on the show last week. And it was a pretty in-depth conversation about energy credits and some of the things that you need to do to make sure that you're claiming all of the different parts of these energy credits that were developed courtesy of the Inflation Reduction Act. And if you think of it, it's almost like a triple layer dip, if you will, in terms of these energy credits, because there's federal credits, the state credits, and there is local or power company credits. And one of the things that this individual wanted to certainly point out and emphasize, and I think it's a fair point, is if you're going to get the credit, particularly the credit that can come potentially from the local power company, oftentimes that audit that Christine and I talked about, getting that energy audit, which actually you get $150 credit towards a $500 energy audit, getting that audit ahead of time and having the power company come out and do the inspection and all of that is required in order to get some of the energy credits that you can expect to get from your local power company. So just make sure you do that as sort of the first point of activity before you go out and start spending all this money on energy related expenses or energy efficient solutions. Then make sure you're going to fully qualify. We certainly would hate if you did that thinking that you would qualify, but then like the power company comes back and says, well, the threshold was you had to have us come out and do an audit so we could see how much you improved by. So just an important distinction on that, and we wanted to certainly bring that up as well. So again, with the Roth versus the IRA, certainly the Roth option is coming to a 401k near you. If it's not already there, it's coming soon. All of that correlates to this notion of if you're going to do your catch-up contributions, then it has to be done on a Roth basis if you were above 145,000 of income in the prior year. What's terrible about that is now that they pushed it to 2026, well, guess what happens in 2026? All of your income tax rates go up. So here you are, you're over 50. You have to be over 50 if you're doing a catch-up contribution. You're higher income earner because the rule applies if you're above 145,000. And now, in a year where tax rates go up, you don't get to save taxes on that catch-up contribution because you're forced to do the Roth. And that really, in terms of how that plays out, is just such a shame that folks are not allowed to sort of be able to make that choice. And the good news, I guess, is that the rule was extended for 2 years. The bad news is it's going to hit in a year where tax rates go up. Certainly, the decision between traditional versus Roth is one that you really do have to look at the tax return because the taxes sort of drive that decision. So make sure you're getting tax advice that you can rely on from whoever your investment person or your financial advisor might be. Sadly, most sort of kick that. Most folks in the financial industry don't engage in the tax stuff. If you kind of look at the disclaimers on the statement, it will say we don't do tax advice or anything like that. We think that's crucially important to be able to do that because it really helps to make the best possible decision. So important to get perspective and advice on these issues. If you have questions on anything we talked about today, give us a call to set up an absolutely free conversation. We certainly do our best to try and stay on top of all of these various changes. And remember, we don't charge for the conversations, unlike so many other firms where they have account minimums and things like that. So make sure you check us out. Visit NelsonFinancialPlanning.com. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.